In time, we'll find out how the dominoes fell. We're in the middle of it today, but it's difficult to see how the chaos is brewing when there are so many moving parts. Every day a new crisis is born, distracting us from another. The financial markets have been essentially stagnant in the US and other nations, as it has been confirmed that the central bank balance sheet and the stock markets are entirely correlated. Without additional stimulus, we can expect to see continued stagnation. But how will you know when the ship will change course? Well, you came here for the truth, so let me unveil that for you. Today we will get into the IMF warning about the global bear market. Let's get into this first. This shoe company said the Obama administration pressured us to stay quiet on the TPP. We're talking about the Trans-Pacific Partnership Trade Deal. The Boston Globe reporting that the US-based shoe manufacturer New Balance has come out hard against the TPP. The odd thing, though, is that the company had gone quiet on the TPP last year, and of course we know why. Now, what is the TPP? The TPP is love, it's friendship, it's smiles, it's rainbows, it's flowers, it's everything like that. And we know that because we've seen other deals like NAFTA and GATT and what eventually led up to the whole EU's creation, all of it formulated from love. Let's move on. The largest US coal company just filed for bankruptcy. That's right. Obama had stated, if you want to set up a coal company, that's just fine, but we'll bankrupt you. And now that's happening. His promise, he actually fulfilled the promise. I can't believe it. Peabody Energy, the world's largest private sector coal producer, filed for bankruptcy on Wednesday in a U.S. court, citing, quote, unprecedented industry pressures. And this is what happens. They want to bankrupt them. Now, regardless of your opinion or my opinion on coal, I will give you a prediction. It doesn't take a genius to figure this one out, that electricity prices are going to rise. If you're shutting down an industry that produces a significant percentage of the energy, well, obviously you're going to send prices higher, and they cannot afford to do this right now. The main article for the day is this out of the Telegraph. The world is sleepwalking into a fresh crisis as investors start to lose faith in policymakers' ability to revive the global economy, according to the IMF. What sort of deals do they want to set up? Well, obviously they want austerity. That's what the IMF desires. They want their nations that they infiltrate to print more money, to create more stimulus packages, and have maximum austerity on the public. In its bluntest warning to date on the cost of policy inaction, that means not printing money, the IMF said the financial and economic stagnation could take hold unless governments prevented a pernicious feedback loop of fragile confidence, weaker growth, low inflation, and rising debt burdens. How are you going to fix both rising debt burdens and weaker growth? The way that they're able to get more growth, at least on paper, is to expand the amount of debt. So they've got themselves backed up into a corner, and this is not going to be able to be fixed. Their intention, of course, is to print a heck of a lot more money, and we need to wait for this to happen. Further along in the article here, the IMF said $1.3 trillion of corporate debt time bomb in China also posed potentially serious challenges to financial stability if defaults pushed banks over the edge. A lot of people believe that China is bulletproof. Nothing can happen to China. And if their growth does go a bit lower, then it's only, let's say a couple percent, and they can still maintain 5 or 6 or 7% growth. But what about the serious issues that were not being addressed, like this? Trillions of dollars of corporate debt. That's important. The IMF's Global Financial Stability Report said a loss of market confidence would drag global bourses into a bear market, global stock markets here. Under this scenario, stocks in the UK, US, Eurozone, and China would lose a fifth of their value over 2 years. And I believe it could be a lot more than that. In my book, I talked about something very important. The stock market didn't return to its 1929 high until 1954. This amounts to a total of 25 years, 9 years after the end of the war. So imagine that. You put your money in the stocks today and it doesn't come back up for 25 years. Would it be considered a good investment for the long haul? That's the challenge that we face with the paper markets, with any asset, if you're relying specifically on its appreciation. That's the danger with any asset. At least 2/3 of all active U.S. corporations paid nothing in federal income taxes in the 2006 to 2012 period, despite an income-dependent statutory tax rate of 15% to 35%. That's according to the GAO. You know, a lot of what the GAO points to is very good. I don't like any of the solutions provided by any of these institutions, but, you know, at least they're pointing in the right direction. Among large profitable entities, 20% paid nothing in federal income taxes in 2012, said the report. And this is from Bernie Sanders. So, you know, they also provided the report for the $16 trillion Fed audit. Nothing ever comes of all of this, but at least it's being pointed at. It's very important to note. Let's look at this here. The fear index. When we look at the VIX, it's continued to move lower following its February surge, suggesting that some calm has returned to the markets. But Credit Suisse has a fear barometer hitting a new high. So the actual amount of fear here, perhaps not the volatility trading day to day, but the fear barometer hitting an all-time record high. That's more than the financial crisis, and we're living in that situation right now because they're thinking, what else could really spark it to go higher? And the fact is that there is nothing. When Wells Fargo opened its first high-tech branch 3 years ago in the District Noma neighborhood, it did away with desks and replaced traditional counters with large touchscreen ATMs. Also gone from its new location, tellers. So they're going full technology right now, and what they're intending on doing, the whole purpose of this, is to replace jobs. Automation and robotics, both good and bad, is replacing jobs. So it does, in fact, bring more jobs to those creating the technology. But ultimately, overall, there's a loss of jobs. And we can see that with the civilian labor force participation rate, where we are at a 38-year low in the total amount of people employed. That's all for this video. If you found it informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my book, The Money GPS, even more informative. If you're interested, you can look through the book. If you go over to Amazon, they have a look inside feature, which will allow you to flip through the pages of the book and see if you like it. Now that 50% of the people are already gone, I just wanted to thank each and every one of you for your donations that I've been receiving. I can't say enough about how much it means to me. I really do appreciate it very, very much. Thank you.